Let's bring on board Sudip Bandyopadhyay, who is now joining in from Inditrade Capital to give us a sense of his views on the markets as well as individual sectors. Let's start off, Sudip, by just talking about the overall environment. Everyone's saying that the first half of this year is going to be very different from the second half. The first marred by a lot of volatility, and perhaps the second is when we could see some of those tensions easing with respect to the big event of the election and even the budget to a certain extent out of the way. What's the view that you have, and how much of a downside are you seeing in this volatile environment?
Well, Avan, I kind of agree with you. The first half is definitely going to remain volatile. I mean, we, as rightly pointed out, we have these parliamentary elections, and any parliamentary election in India, historically, there has been volatility. Also remember the global volatility. I think there are also multiple uncertainties in the global economic and geopolitical arena. And, these things are creating volatility even in the global markets. So we have to be cognizant of that as well. But having said that, our view is that fundamentals of Indian corporates as well as Indian macro fundamentals are by and large pretty robust. As long as the oil prices in the international market doesn't suddenly start shooting up, chances of which are extremely unlikely, I think we are in for a solid macro and micro performance in the current calendar and next fiscal. So I think second half, if this hypothesis holds good, second half of the current calendar year as well as majority of the next fiscal, we should have a good run. There are a lot of fears built around coalition governments and things like that, but historically it has been proven that coalition government doesn't necessarily mean instability as far as the capital markets are concerned.
Right. Sudip, hi, afternoon. Wanted to understand what is it that you made of Zee's quarterly performance? It's a blowout set on all parameters, be it ad revenues or the subscriber base. They've managed to beat street estimates. And we were chatting with the management, and Puneet Goenka reiterated that he's aiming at a growth level of 30% plus on EBITDA margins in FY 2021. After how much upside would you say that positive growth target of theirs would be baked in?
Well, I think this result was definitely sweet music to the ears of market participants. There were significant concerns regarding the investments in the OTT platform, as well as some amount of uncertainty as far as the stake sale by the promoters. But the results definitely stands out. Also remember the management commentary, they are very, very bullish for the next 6 months as far as ad revenues are concerned, and naturally so. The economy is moving at a decent pace. B, the elections are coming. That definitely increases the the ad spend overall. So I think as far as the business revenues are concerned, it's looking good, and that's what the management commentary came out as. Also remember, we have been bullish on Zee predominantly on the back of the fact that promoter divesting shareholding doesn't necessarily mean bad for the stock, and if a strategic partner comes with some repute in the related space, I think that should be excellent news for Zee as well as the investors in Zee. So we are bullish on Zee, and even at current level we feel it is worth looking at acquiring. Of course, you have to remember that you are taking a little aggressive bet, and you have to live with that volatility in the counter. We have seen the prices correcting predominantly on the back of profit taking today, but we are bullish. I think it's worthwhile taking that bet.
Sudip, we are seeing great move in Infosys. We heard management commentary. We also saw that they have revised their guidance upwards. TCS commentary was more bullish than Infosys, but we are seeing TCS correcting. Now there is a valuation gap which we all know, and that valuation gap to some extent has corrected in last 1 week or so. How are you positioning yourself from a portfolio management perspective in IT space? First of all, are you bullish on IT? Secondly, what you will choose between Infosys and TCS, and why?
I think as far as overall IT is concerned, we are cautiously optimistic. By and large, the large IT companies have started getting their act together, and that's getting displayed in their quarterly performances. Mid-cap IT is an interesting space, and there are significant opportunities because the valuations are not as rich as in the large cap, but you have to be extremely careful in picking up the right stock. So overall, if you ask me, we are cautiously optimistic. You have to be stock specific, but there are opportunities. There are more opportunities of making handsome returns in the mid cap than the large cap. Now coming to the specific question between TCS and Infosys, I think I will go for TCS still. Yes, it has corrected post the results. Look, I think a couple of things came out very clearly from the management commentary and the last quarter results. TCS has successfully moved to the digital universe, and a significant part, close to 50% of the revenue, is from digital. And I think that's a significant development for the future. Also, the client additions haven't been that great in this particular last quarter for which results were announced, but the overall client bouquet has been robust. The India business has been robust. I'm not saying Infosys has done a bad job. They did a fantastic job as well, and the results are quite impressive. But having said that, I still believe that the valuation gap is going to remain for a reasonable period of time. I won't say very, very long. If the performance continues on a similar trajectory for both Infosys and TCS, TCS still continues to be the leader, and they will continue to remain leader for the foreseeable future. So I will go for TCS. If I am a long-term investor, I have 1 year plus time horizon, even current valuation, both Infosys and TCS are worth buying. If I have to pick one, I'll pick TCS.
Okay, fair point. But Sudip, what is your own sense on where this entire situation is headed? Beggars can't be choosers, but in the current form, as we understand, like my Economic Times colleague as well was highlighting, that Etihad is not willing to pay anything more than 150 rupees per share. In that scenario, clearly it doesn't seem like this deal is going to go through.
Aisha, I have a slightly different view here. I think Etihad is negotiating. They're trying to get a good bargain. I'm sure the initial demand on pricing the shares would have been something close to the market price. So Etihad is trying the other route. They're just talking about a ridiculously low price and trying to drive a hard bargain. That's my take. They understand the law. They've been advised by the lawyers. And probably they know exactly what all needs to be done and what is feasible, what is not feasible under the current scenario as far as Indian laws are concerned. So to my mind, this is a kind of bargaining tactics as far as Etihad is concerned. They're trying to drive a good bargain. They will have to come in. They don't have much of a choice, otherwise their investment sinks. Also, as far as Jet Airways and the lenders are concerned, there is very little options. So some deal has to happen with Etihad coming in, but they will try and extract their pound of flesh.
Sudip, what's the outlook with respect to the auto space as a whole? Do you think that after getting a sense as to what the December auto sales numbers were like, that the weakness in terms of overall volume growth in light of the current macro environment could potentially persist? Do you like anything within this space?
Well, I think December numbers will have to be taken with a pinch of salt. I would say that normally the companies change model, come up with new models in the new calendar year. So December sales or the December models are not preferred by the customers. So there is always a tendency all over the world for the sales to come down in December. As far as our specific market is concerned, we had this insurance cost increasing, which did create some amount of dissonance in the market. The third, and I think to an extent very important, was financing was a bit tight due to the NBFC liquidity issues, particularly in the commercial vehicle space, and that's why the numbers to an extent did suffer. So I would say let's not read too much into December numbers. This slowdown is real. Definitely there is a slowdown as far as the vehicle sales are concerned, but let's not read too much into December numbers. As far as the opportunity is concerned, I think the opportunities will be in the lower end of the market, and that's exactly why we prefer a company like Maruti. I think it corrected significantly. From there it moved up. Again it has corrected. At current levels, I think it's a good buy. We have a target of around 9,000. I think investors willing to wait for about a year can buy Maruti even at current levels. As far as two-wheelers are concerned, we like Bajaj Auto. Apart from domestic market aggression, they are also having good traction in the export markets, particularly in the South of African markets, and that augurs well for Bajaj Auto. So current level, we are a buyer in Bajaj Auto. As far as commercial vehicles are concerned, Ashok Leyland has been beaten down continuously. Numbers, the axle load change norms and the CEO resignation all have affected its performance in the market. But we believe for a long-term investor, it's an excellent buy at current levels.
Okay, fair point. That's the word coming in autos. But SBI has put SR Steel loans on the block for sale. They've set aside a figure of 9,587 crore rupees as the reserve price for the loan sale. They've invited bids, as we understand, from ARCs, banks, NBFCs, as well as the financial institutions. The SBI management had earlier today quoted to ET Now saying that, or rather during the second quarter earnings, I stand corrected, that there is that potential write back of 6,000 crore rupees, which is possible in SR, and they do expect the NCLT accounts to be resolved by 2019, and the provision cover for power sector stands at 41%, and they had listed two of at least three accounts are going to get resolved in Q3 itself. Sudip, where is it that you're finding opportunities when it comes to banks, or are you with the most popular trade on street right now? Stick by with corporate banks, ICICI as well as Axis?
Well, I was advising buy in Axis as well as ICICI for last 3-4 months. There is a strong logic behind it. I think they have completed the kitchen sinking to a great extent, I would say, and things are going to improve from here on, definitely for both these banks. They have a stable management now, the new management in place. But having said that, I think the valuation has moved up quite a bit. So I won't advise investors to rush into buying Axis or ICICI at current levels. Let's wait for the current quarter numbers, and then we can take a call. As far as the buying in this space is concerned, I will prefer rather smaller mid-cap piece private sector banks. Federal Bank is one bank which we like. We also like South Indian Bank and City Union Bank. I think investors can look at these banks at current levels.